Hey, Adam Gower here of GowerCrowd.com. Thank you so much for joining me for today's podcast episode answering what is a bear market in commercial real estate. Now, we build crowdfunding platforms for real estate sponsors so that they can raise capital online. We provide educational resources to investors so that they can make prudent decisions on what to invest in. And so consequently, we have a broad visibility of opinions and insights across the market. One of the things that we also do is we conduct very thorough search engine optimization research, SEO research. And the number one question that investors across the board are asking at the moment is, what is a bear market in commercial real estate? And so I invited Paul Fiorilla, who is Director of US Research at Yardi Matrix, to join me today on the podcast to answer that very important question. Paul very kindly also produced some slides for the podcast that we do go through during our conversation. You can see them if you watch the conversation, of course, on video. You can do that at GowerCrowd.com on the podcast page. But if you are listening and you would like to access those slides, just go to the podcast page at GowerCrowd.com, where you will be able to download that whole deck. And while you're there, if you are not already a subscriber to the GowerCrowd newsletter, go ahead and hit that subscribe button on the top menu bar. Sign up. It's totally free. It is the only resource in the commercial real estate industry that covers exclusively the real estate crowdfunding and syndication world. All right, that's it. Let's find out. It's not such an easy question to answer, actually, but Paul does a very good job, as you would imagine. What is a bear market in commercial real estate? Here he is, Paul Fiorilla, Director of US Research at Yardi Matrix. Paul, such a pleasure to see you again. Thanks so much for doing this. As you know, this is the hot question of the day. Let's just jump straight in with it. What is a bear market in real estate? And I know there's lots of layers to that. Well, let's just start with that.
Well, hello, Adam, and glad to be here. Did this once before, and it was a lot of fun, and I always love talking about real estate. So, yeah, let's get into it. So, what is a bear market in real estate? Well, generally, in the real estate market, we don't use that term as much as we might talk about a downturn or a bubble. And generally, I would say it's a period where values are declining and fundamental drivers, rents, that's being driven by, reduced demand and a period of economic low growth or negative growth, like a recession.
Now, a bear market in stocks has very specific definition, doesn't it? It has to have a decline of, and you've got it up on the screen here. For anyone watching or tuning in today, if you want to watch, go to GowerCrowd.com to the podcast page, because Paul actually is sharing some very interesting slides. We will talk through them, so don't worry. We'll give you some clarity. But if you want to see the slides and the charts that are coming up, definitely watch this on GowerCrowd.com. But a stock market bear market is a 20% decline in values, isn't it, over a certain period of time? Has to last for 3 months or something. Is there something equivalent in real estate?
Not really. I've been in the market 25 years, and I don't think that there is anything official. And I think part of the reason is that, there isn't a kind of index like the S&P 500 or the Dow Jones. The vast majority of commercial real estate is privately owned, and it's not priced on a daily basis. And there are indexes which we will get into, but they're not, they're quarterly, they're priced quarterly. And so you can't just say, hey, what's the price today? You can look at a basket of REIT stocks, but again, that's, REITs are a much smaller part of the market than private real estate. So it's not like you can point to a particular index and say, oh, it's down, Plus in real estate, you have all different property types, you have all different regions, you have a lot of variety, and they don't all act in concert.
All right, so let's go on to this next question you've got on the page here, which is how does one of the things we talk about with real estate is that it is directly related, commercial real estate investing, to the overall economy, right? The economy is doing well, real estate will do well. If the economy is doing badly, there is a correlation typically between these two. But what about a bear market in stocks? Is there an impact of that on commercial real estate?
Yes, I mean, there are correlations between, what's going on in the stock market and the economy. I guess to the extent that there's, the economy affects the stock market, that also could impact real estate. So, but it really depends on why the stock market is declining, why there's a bear stock market. So if there's an event like the war in Ukraine, or the Fed's going to raise rates, and investors suddenly get very pessimistic, the stock market can drop dramatically, but that doesn't necessarily translate into an immediate impact in private real estate. So, with private real estate, what really matters is demand for fundamental drivers, supply and demand. Is there demand to occupy properties, and each property type has its own type of driver? And if so, how does that relate to the amount of supply? Are we oversupplied? Is there enough? Is there not enough supply? Right now, for example, the industrial market. Uh, there's, I don't know, 5, 6, 800 million square feet of demand, and the amount of construction is less than that. So industrial uh, occupancy rates are going down. Industrial rents are going up. The
Vacancy
industrial
rates,
market
vacancy rates are going
vacancy
down.
rates are I'm sorry,
Going
going
down.
down.
Right.
And right, so the industrial market is really hot, and so whatever's going on in the stock market doesn't really affect that short term. Now, if stock market declines because the economy hits a recession, then that will affect demand for industrial real estate. People will stop buying consumer products. There'll be less of a demand for warehouses and logistics centers, and eventually that'll work its way into um, fundamentals for industrial real estate properties. So, if we're talking about the market right now, um, I think the stock market declined for a couple of reasons, and I'm not an equity analyst, and so I'm
Right, you and me
speaking
both.
rather broadly. I mean, I'm not,
Yes.
yeah, I'm not, don't mistake me for somebody from Goldman Sachs or ISI Evercore, something like that. But look, the stock market had a huge run up, and it's kind of back down to where it was a year ago. If you look at the multi-year returns, they're still pretty good. So I mean, the stock market was flying a little bit too high, in my opinion, and I think that's part of the reason it went down. Plus, you have the issues with inflation and supply chains, and energy prices, things that are worrying to investors. We've got the Fed's going to start raising rates to cut growth.
Right.
So all those things are a worry to equity investors. Um, but as far as real estate goes, real estate fundamentals of most property types are still pretty good. I mean, we're looking at the economy, job growth is good. Again, this might not continue for another couple of years. I think there's a very good chance that economic growth will slow to a crawl, or even we might even have a recession in the next year or two. But at the moment, demand for commercial properties continues to be really strong, and the things that drive demand for commercial real estate, are pretty good. Like I said, job growth is really good. We're almost back to where we were. We're just a few 100,000 jobs, I think, away from where we were pre-pandemic. We've had almost 7 million jobs added since the beginning of 2021. We've seen consumer balance sheets remain pretty strong, even with the recent drop in stocks. So there's a lot of demand for consumer products. That's good for retail and industrial real estate. And
let's jump to that slide that you've got. It's a really good slide. The other one, you were just on it. That one, yes.
This one here.
Let me just describe what this is for those who are just listening in. So this is a graph with 3 lines on it that compare relative returns between private real estate, which is essentially this crowdfunding world, and then the non-crowdfunding world, private real estate, REIT returns, and the S&P 500. So, Paul, describe what we're looking at, because it's an extremely interesting chart, isn't it?
So this is a chart that goes back almost 25 years, I guess 24 years, and it maps the quarterly returns of private real estate, the S&P 500, broad index of stocks, and then REITs, which are publicly owned real estate. So the dark blue line is the line in the middle, and you can see that there's a period in the global financial crisis where prices dropped fairly dramatically and then rebounded. But the volatility in private real estate is much smaller than the volatility.
If it weren't for that, frankly, if you look at this chart, if it wasn't for the global financial crisis in 2007, 2008, it's almost a straight line for the last 25 years that hovers, I would say, probably around, what would you say, 3-4% maybe returns annually?
Yeah, and I think this is just appreciation. I don't think this. I just had this made up this morning because I didn't.
For today, thank you for doing that. Yeah, but I really appreciate it.
But the private real estate, I think there's like the average dividend is also about 4%, so it's very consistent. And this NCREIF property index is sort of institutionally owned properties. It's stable, kind of core property, so it tends to be a little bit more stable than all privately owned real estate. But I think I think what you can see there is that there's very little correlation between private real estate and the stock market in the short term, and there's the REIT index. There's a much greater correlation to the stock market, but they're also not entirely correlated either.
It's pretty close, though, isn't it? I mean, there are some anomalies.
There are periods where they diverge. So like in the early 2000s, I think that the real estate market was affected by that recession that which I guess started in
well, that was the dot-com boom, wasn't it? Yeah.
That was
bust at that time.
Yeah, the dot-com bust kind of, the S&P kind of dropped fairly dramatically.
But real estate stayed the same. But what's interesting about this chart is this incredible volatility, frankly, compared to private real estate. When you look at the S&P REIT index and the S&P 500, I mean, you've got this. This is a classic sign of the stability of private real estate, isn't it?
Right, because you price commercial properties based on their cash flow, and the cash flow doesn't change day to day. The stock market is priced day to day. Investors are looking, what's going to happen, and they're trying to guess what's going to happen, and they're spooked by things or encouraged by market things that happen, job reports, interest rate changes. And that kind of leads to wild swings. It leads to a certain amount of volatility. But commercial properties, their income is derived from leases, And depending on the property type, those leases, hotels are the most volatile property type because, they're day-to-day leases. And so in 2001, when, we had 9/11 and people stopped traveling, hotel, income went down dramatically. Hotel income went down dramatically during the COVID-19, and it's rebounding now. But if you have an office building, your leases are 5-10 years, sometimes longer. So the situation we're in now, where there's not many people going to the office, the latest numbers show, I think nationally, 40% utilization of office buildings, down from a little more than 60% before the pandemic. So there's been a dramatic decrease in the use of office buildings. But you know, office buildings have tenants, and the vast majority of them continue to pay their rent. Now, maybe in a few years, when the leases, come expire, the tenants might not renew leases or might downsize their leases, and we can see that's already started to happen. But it's a slow moving process because the leases, the underlying income that the underlying income is derived from, isn't doesn't change day to day. Same thing with retail, right? And retail has some issues with regard to the long term. Are we over retailed? Are people buying online, or people not going to physical stores as much as they have? But that is a slow moving long term process, and it doesn't show up in every property. If you look at big picture national numbers, the occupancy vacancy rates of retail centers has been affected, but not as dramatically as you expect based on the news that you hear day to day. And apartment buildings, their apartment is also, like industrial, an extremely hot segment of commercial real estate. We've had, over the last year plus, it's been by far the best year for rent growth. And there's a lot of reasons for that: long-term supply demand, and the bounce back, pent up demand coming out of the pandemic. We just haven't had enough housing built over the last decade, and after the financial crisis, a lot of housing construction slowed dramatically for a few years. So we're kind of we have a pent up lack of supply and a pent up demand, coming out of the pandemic. So there's a lot of demand for apartments. Apartment rents went up 15% last year, according to our data.
Isn't that incredible? That's
It's
really
it's
incredible number. That.
yeah, it's incredible. And if the economy slows down, that's not suddenly all going to turn around. I mean, first of all, apartment leases are mostly for a year, so it takes time to for that to change. But at the same time, people need somewhere to live, and there's so many households being created, and like I said before, consumer balance sheets remain fairly strong because of job growth and wage growth.
Right.
So the fact that the stock market's gone down, doesn't really have a lot of bearing in the short term on things like apartment demand.
Right.
Now, if the economy goes into a recession and job growth, turns negative, and wage growth goes down, and all right, so then you might have in another couple of years an impact on the apartment market, but it's not directly correlated to commercial. It's not directly related to what's going on in the stock market.
So one of the things, the data that you're sharing with us today is macro data. It's based on huge data sets. So I want to share with you what we're hearing anecdotally, right? So I'm not consolidating. I'm not I'm not aggregating huge amounts of data. These are just anecdotes from across the country. But the one area that is very interesting that I'd like to talk to you about in the context of this idea of a real estate bear market is multifamily, is apartment market. Clearly, it's one of the most efficient markets because there's a lot of people involved in it. There's a lot of money chasing these assets, a lot of knowledgeable sponsors looking for assets. It's an efficient market. And what we're seeing or hearing is that there are some downward pressures. Two things actually interesting. The caliber of buyers, this is a little bit out there, for larger assets is substantially degrading. In other words, institutional players are apparently sitting on the sidelines, right? Now, these are anecdotal indications. But what's also happening is that there is downward pressure on prices. So clients that we have that are selling assets and folk that we're talking to are selling assets in the tens of millions, right? So larger apartment buildings are seeing retrades and offers that are depending on the asset, on the class of the asset. So class Bs are seeing prices softening between 5 and 10%, and class Cs with value add potential 2Bs are seeing declines between 10 and 15%. That is significant decline in values. What do you understand from that? What do you take from that in the context of a real estate bear market?
I think that, comports to anecdotally what I've also been hearing. And, look, the price of multifamily is at an all-time high in 2021. There were, we track properties with 50 or more units, and nationally we track 200 and roughly 215 or 220 billion dollars of multifamily sales last year, which was, probably 60-70% higher than the previous highest year. So there and the price per unit was about 20% higher. I think it was about about $195 a square foot or per unit, $195,000 per unit, which is about 20% higher than the previous high. So there was a huge, increase in multifamily values last year. In the last, they've been increasing steadily over the last few years as multifamily performance has been really good. So, and that was for a few reasons. Number one, it's considered a very safe and stable investment class. And, when institutions are looking to buy, what are they looking to allocate money to? They'll say, hey, do I buy real estate? Do I buy fixed income? Do I buy, stocks, whatever? And multifamily, because of its really consistent dividend yield, the very strong prospects for multifamily performance in the next few years, that there just was an incredible amount of money going into that segment. So, if there was a property on the market, there were, could be dozens of bidders.
So hang on, let's look at you're absolutely right. Let's look at that other slide you've got. It's a really cool slide that shows it's the relationship between, is it multifamily yields and the 10-year Treasury? I think it's a very cool slide.
Oh, okay. So, right. So,
is that it? So talk about
can
this.
You see that?
Yeah, sure can. Cap rates and Treasury rate. Yeah.
As I was telling you before, I didn't have enough time to update this slide. This is a slide I had used for a presentation. And,
a couple of years ago, but it's still very interesting.
But right. So how do you price properties? Well, you take the investors will look at the the cost of capital. They'll look at the the risk-free rate, the 10-year U.S. Treasury, and they'll decide how much of a return above that they think is appropriate for the risk of the asset they're buying. I mean, that's just basic economics 101. But the thing is that as you can see from this, the premium that investors want over the Treasury rate, is not consistent. It goes up and down. So in periods, and if you were go back, if this chart were to go back, another 10 years, in 2007, the market got really aggressive, and the premium between the Treasury rate and the acquisition yield or the cap rate was under 2%. So, and that means that investors were confident that rents were going to keep increasing. And when investors project that rents are going to grow strongly, like in multifamily, like they have recently, then you're willing to accept a lower initial going in yield because you think, well, in a couple of years, my rent will go up 5, 10, 15% or whatever. And so that'll make my yield a lot higher. So when they're confident about future cash flow, they'll pay lower yields. Lower yields mean higher prices. And so that's the situation we're in. Where's my other slide?
But when you see prices going down, that implies that cap rates are going up, and there's a relationship between cap rates and. Okay, go ahead. You got another thing.
So you can see this other slide. Yeah. So a lot of multifamily properties are being sold. So this is a slide where, again, I created this for a training program a couple years ago, and I assume that a property has a 1 million NOI, just to pick a round number. And when the market is when there's a frothy, strong market, and investors are confident in cap rate right now, like the average cap rate for multifamily is somewhere about 4.5%, and it's less than that for stable properties, Class A properties in strong markets. So let's say, you have a property with a 1 million NOI, and the buyer takes a 4 million, accepts a $4 million, 4% cap rate. Their initial yield going in is 4%. That property would be priced at 25 million. Now, 10 years ago, when cap rates were closer to 6%, that same property with the same cash flow would be worth 16 million. So you can see, depending on the yield that the investor is willing to pay, it has a very large impact on the value of the property. And when you look at that in terms of the mortgage, I also mapped this out. So, back in 2007, when there were 90% mortgages, banks were handing out 90% leverage or more.
I imagine that, yeah.
And you could see that property with a 1 million net operating income, maybe you could get $22.5 million worth of debt on it. And what that means is that property then becomes kind of subject. It's the risk that if there's a downturn in property. So you said right now there's a 10%, 15% downturn in prices because as interest rates have gone up, the lending rates have gone up. So the cost of capital has increased 150, 200 basis points. So that has reduced the amount that investors can pay and make the same amount of profit.
Yeah, it's not true. Let's just actually drill down. This chart this table that you've got on the screen doesn't tell the whole story. So let's just chat about that whole story. I'm just kind of throw some ideas out at you. Let's say somebody bought a building at 4% cap rate, right? It's got $1 million of NOI, 4% cap, 25 million. And now what we're seeing is, and I actually ran these numbers in a spreadsheet, almost exactly the same numbers, not quite. Yeah. So starting with a 4% cap rate, I actually assumed 400 because a few slightly different assumptions, but the numbers will basically relate fairly closely. With a 15%, right? So this is what we're hearing in the market, 15% decline in value. That means the cap rate has gone up to 4.71, right? 4.71, right. Which is almost like approaching your 5%. So let's just think about that. Now you're looking at a $5 million discount in the value of an asset. And what is that discount? Entirely equity. That is all equity. That is not hitting the debt. So you're still holding on to your
where I
deal.
was just about to go when I was, talking about this was just very briefly is that, yeah. So it means that, right now, if you are buying a property, you should be very conservative and not, first of all, try not to overpay, but also in the amount of debt that you're taking out, you want to be very careful because if if the values go down 10%, you're going to be underwater pretty quickly if you are too aggressive
Yeah, and
in
from an
your,
investor's perspective
acquisition. Right.
also, right? And you also want to be like, all right. So let me ask you. I know you're going to love me asking you to do a prediction, but surely the impact that we are seeing on prices, this downward pressure on prices, therefore upward pressure on cap rates, people want higher returns, is directly related to an increase in interest rates. And so far, we've only had one. Basically, one major one, right? 50 basis points, but there are a lot more coming. If you were to project where cap rates were going to go or what trend they would follow over the next 6 months, right? 6 to 12 months, what would you be talking to investors about?
Well, I'm not going to predict interest rates because I know
Let's assume they're
nobody.
going to go up. I mean, there's a general
Yeah, I mean,
consensus
I
that
think
they're
there's a
going
good
up.
bet. I mean, I think our baseline, forecast for the, sort of our corporate forecast is, that expect that the 10-year Treasury is going to be somewhere about 3.5% by the end of the year. But I mean, that's just an educated guess, right? Very few people can, pick interest rate, to in the future at any, to accurate degree. But I think that yes, look, first of all, it depends on the asset type, right? I mean, I think multifamily and industrial because the the growth in rents is so high. Again, I mean, multifamily rents this year are still up 14% year over year, and so I think that covers up where that helps to keep cap rates low in the face of rising interest rates because investors like if they were underwriting 3 to 4% rent growth, I think that clearly prices would be down 10, 15, 20% based on the cost of capital, the cost of debt. But when you're baking in 10, 15% increases in rent, um, then you can keep pricing fairly high. And now again, I would, if I'm advising people and I'm not, that's if I were to tell you what my opinion is, I would say to look, I would not underwrite kind of excessive rent growth. I think you can underwrite it. I think you can expect in some property types some rent growth, but I wouldn't, I would, if I was buying something, I would, be a little bit conservative in those estimates because, you have to account for the possibility of, a recession, interest rates increasing more than might be anticipated or, rent growth slowing down, I mean, that was really in the global financial crisis, um, what the three things that created a lot of the defaults and a lot of the distress in real estate were, one, that investors were underwriting, excessively large increases in rent growth. They were taking out too much leverage, and also they were underwriting, exit cap rates that were super low, as
Right.
low as they bought the property. So
Mhm.
all three of those things together, created an extraordinary amount of frothiness. Now, we haven't seen that, that level of aggressiveness. Banks are not lending, 90% anymore. Um, and rent growth actually has been good. So if deals that have been done in the last couple of years have benefited from that that rent growth. So I don't see the market as facing like a 2007, 2008 type calamity. But nonetheless, it doesn't make any sense for an investor to go into a deal right now, too optimistic. And, to get back to what you were saying before about anecdotally about deals, I mean, I have heard that, there've been a lot of deals that are being retraded where where somebody had bid a really, high price that would have made sense a few months ago, but, banks are reducing the amount of leverage that they're handing out right now. Maybe the buyers have changing their assumptions about, going forward projections. So, they might be, backing out when they can. So, and I think that, you know, I've also heard that it's prices aren't going down as much as, a lot of people are sort of taking a pause. And, if you don't have to sell right now, you might decide, you know what, I'm not going to sell while prices are low. You might expect that, the market will recover in another 6 months. So I think more than deals getting traded at lower prices, I think a bigger thing is just that, that there's been sort of a pause in, the really rapid deal flow. And I think there'll be kind of, the market will kind of feel itself out for the next few months until maybe they, investors on both sides of the equation think there's a little more clarity.
Are you seeing any downshift in institutional activity in commercial real estate as interest rates go up and they kind of figure out what's
Yeah.
happening with the economy?
I haven't heard that institution. I mean, I'm sure there's a lot of institutions that, their investment committees have, are looking at what's going on and saying, like I said before, that, hey, we better, before we, buy anything, we should get a little more clarity as to where we think things are going. I don't think, in generally speaking, that institutions have less, demand, that the institutions are allocating. I mean, they might be reducing some of their allocations, but I haven't heard of like a wholesale change in that direction. And I mean, you look at news and announcements from institutions. There's still a lot. I think some of what might be going on would be, they're reallocating some of their capital from maybe major sectors to niche sectors like self-storage or
I see.
single-family rentals. There's a ton of institutional interest in those products. Medical office, life
Mhm.
sciences, um, different property types where they're not quite as crowded and, with institutional investors, and maybe institutions are allocating to segments that they think are less competitive. There's higher yields and also good prospects for the next few years.
All right, so let's. I'm going to ask you a slightly negative question. Then we'll figure. Well, then we'll conclude with something positive. But Jerome Powell, Fed Chairman Powell, has talked about increased interest rates, inevitability of interest rates over the next few months to temper the rise of inflation. And the general narrative that surrounds that is that there will be some pain, right? There will be pain. What does that mean for commercial real estate? What does pain mean for commercial real estate?
Well, I think the concern for commercial real estate, there's two things. The increase in, debt capital. Mortgage rates are going up, and like if, home buyers, when rates go up, their monthly payments, they can't, the monthly payments increase, and so they can't afford to pay as much for the house, and that has an impact on house prices. And I think, the same principle applies with commercial. As rates go up, you can't buy a property at, 4% if your mortgage is 5%. That's negative, right? That's not going to work. So that, to the extent that, the rates go up, and the 10-year Treasury and goes up, and even on floating rate debt, the
Mhm.
cost of this is a huge thing that, in the last couple of years, there's been a much greater percentage of commercial loans that have been originated have been floating rate rather than fixed rate. And usually, especially institutions, when they take out floating rate debt, they'll buy an interest rate cap.
Hmm.
And the cost of those caps, which mean the cap means that there's a limit to how much the interest rate can go up. So if interest rates go up a lot, if you buy a cap, you're limited. So you can plan on, like, hey, here's the worst case scenario. The cost of buying those caps has increased dramatically, is doubled or tripled, or so if you want to take out a floating rate loan, it's going to cost you a lot more. So that, again, that just goes into your cost of capital.
Right.
And the higher your cost of capital is, the less you can pay and meet your yield. So um, your yield targets. So I think that, clearly that's one issue that the market is, it's a negative, on the market, negative drag on property values. And then look, if the Fed is successful in slowing economic growth so that inflation is reduced,
Mm.
that will have an impact on demand for properties, right? So in that environment, fewer people getting jobs, people won't be able to, form households. Young people, let's say, who are
Mm.
laid off, or living with their parents, so they don't form households and take in and rent apartments. There'll be less demand for office buildings. Retail, retail sales go down. The retail industry, you could see, retail chains that go out of business, and that
Right.
reduces occupancy in the retail centers. I mean, interestingly, a lot of people, during 2020, there were a lot of store closings. 2021, there were more openings than closings, which surprised a lot of people, because there's a lot of, the idea that everyone's going to just buy things online from now on, and there's going to be no need for retail centers. That's not been the experience. I mean, look, we definitely have too much retail in this country, and I think that there's a lot of retail.
Mm.
There's a big bifurcation. Some retail is great, and it's going to be do well, and properties that are not well located, or not don't have the right mix of stores, are going to definitely lose tenants, and have to be converted into something else. So it's not like everything isn't great for retail, but the retail apocalypse that a lot of people
Mm.
sort of forecast didn't happen. And
Mhm.
so, but clearly, if there's a downturn, and the consumer spending slows down, declines, then that's bad for retail real estate. So so the two things are, increases in capital costs that affect property values, and a slowdown in the economy that would reduce demand for commercial properties.
Paul, let's wrap up. I'm actually going to stop sharing because I want to stop your screen sharing so that you and I can just kind of chat just as we wrap up here. You produce some really incredible articles. You produce some really incredible reports over there at Yardi. What are you working on at the moment? What can we look forward to in your pipeline?
Oh, let's see. Well, I've been, I just produced a paper about, uh, we looked at multifamily transactions over the last decade,
Hmm.
and we looked at repeat property sales. And we have a database of 83,000 plus multifamily properties in
Hmm.
more than 160 markets in the US, and more than 4,500 of them were sold more than at least three times during the last decade. That there's just been an incredible demand, as I said before, for multifamily.
Hmm.
And I was curious to look at that. So we did an analysis of just the properties that were sold three or more times. And there was a clear, um, a clear trend that you could see in that investors, the vast majority of them were in the Sun Belt. And so investors are increasingly, it used to be institutional investors kind of focused on, the big markets, the top 10 markets in the country. But now there's a lot of capital going to the Sun Belt where investors assume that, population is going to grow in those cities, the Charlottes, the Tampas, the Dallas, the Phoenix. All those markets are the fastest growing markets. Austin, they're all the fastest growing markets in the country. And the vast majority of these repeat sales took place in Texas, Florida, Arizona. And the other thing that was interesting about it was that for the most part, these were smaller properties. And you could see
Smaller
that
being what? At what size?
smaller, properties of less than 100 units
Okay.
and Class B and C. So, stable Class A properties, properties in, the Northeast, or, even, some of the gateway markets in the Northeast or in California. They're more stable. And I think that because the prices aren't, there's not a lot of possibility of outsized growth in prices in some of those markets. So investors focused a lot on Class B and C properties in growing markets in the Sun Belt, kind of with the idea that you can take these properties, you can fix them up, and then you can raise rents, by a lot. You can't go to New York City and raise rents by 20%. It's already, the average rent is, $3,000-$4,000. That's not going to work. But you can go to, somewhere in the Phoenix area and raise rents from 800 to 1100, and
It's
by doing a
profound. So
little.
did you, so with these, and I'm actually looking at your LinkedIn profile. So anybody who actually wants to see this full report, go to LinkedIn. You see under Paul's profile there, he's actually posted this thing. So it's fantastic. I'm going to read it afterwards. But did you notice also a higher price inflation for those that flipped 3 times in the last 10 years versus those that didn't flip so many times?
Well, we looked at we did a compound annual growth rate of these properties, and in fact, the I think the average nationally was something like 17.7%. So that was a pretty fair increase in prices, and prices of everything, all multifamily increased, but not quite at that level. So I think there
Over
was.
what period of time is that 17%, Paul?
That was over the decade where we did the study. So we looked at the price of the first sale, through the price of the last sale for those properties during that time, and calculated the growth rate. And we didn't calculate the same for every multifamily property. So I can't tell you definitively what the actual average was for all properties, but I'm pretty sure it wasn't as that high. I'm sure that these properties had a higher growth rate than the average multifamily property.
Well, Paul, your reports are really phenomenal, incredibly valuable, and very interesting. Thank you so much for pointing me to that one. Let's wrap up, and just with me saying thank you. Actually, just make sure that I got your title right. Director of U.S. Research, Paul Fiorilla, Director of U.S. Research at Yardi Matrix. Is that correct? That's still your title?
That's right. And yardimatrix.com/publications, you can go and read all of our research publications.
Thank you so much. Such a pleasure to see you, Paul. Thanks for joining.
Yeah, it's great. Thanks for having me.
All right, that was Paul Fiorilla, Director of U.S. Research at Yardi Matrix. He does produce some of the best research and analysis of commercial real estate investing in the country. Find out more about him at the podcast page on GowerCrowd.com, where you will also be able to download slides, actually, from today's presentation. It's really interesting, some very deep insights. Go ahead, to GowerCrowd.com. Find the podcast page while you're there, of course. If you're not already a subscriber, please subscribe to our newsletter. It's totally free, and it covers the world of real estate, crowdfunding, and syndication in more detail than anybody else on the planet. So go ahead and sign up there. It's totally free. Paul, always good to see you. Thank you so much for joining me today. And to our listeners, to you also, thank you so much for spending some time with me and my guest today, Paul Fiorilla. It was a real pleasure to talk to him and to learn from him. I hope you enjoyed listening as much as I enjoyed putting the podcast together. That's all for today. That's all for this week. Tune in next week to hear the next episode. And in the meantime, stay well, be safe. This is Adam Gower signing off.